Hey guys, Chuck Barone here. Thanks for tuning in to another episode of our show. Today's Tuesday, June the 21st. Very, very busy day. A lot of news to cover today, a lot of stuff going on. Before we get into the show today, though, I do want to take a second to thank my man, Greg Manarino, for all his help in helping us launch this channel, for screaming at me and nagging me for months and months and months to finally do it. He finally nudged me across the line, and I gotta say, I'm having the time of my life doing this stuff for you guys. I hope you appreciate the information, and I hope you appreciate Greg. This is a guy who really cares about his people, wants them to get the best information that he believes is available to them. And I'm truly grateful to my man, Greg Manarino, my brother from another mother, for all he's done for helping us launch this station. Getting into today's action, markets had a nice day today. It was really nice to see it. The markets had a nice bounce. The Dow Industrials going up nicely today, more than 2%. NASDAQ had a nice rally. S&P, broad-based rally, really, really good. The Bitcoin also bouncing up from support, really had a nice day today, up over $1,100. The bond market was flat today, with the 10-year settling at 3.30%. Now the market's great. It's really kind of, when I see a market rally like this in the face of all this bad news, I'm kind of wondering, okay, well, why is this market bouncing? I guess we're due for a decent day after all the bad news we've had over the past couple of weeks. But I really thought that there's got to be a deeper reason. So I went snooping around, and I found out today an interesting fact. Our buddies, the hedge funds, have right now the largest short sale percentage of their portfolios they've had since 2008. So back then, when they knew the big kablooey was coming, they got themselves short and probably had a great ride then, and I'm guessing they're setting themselves up for a great ride now. But as a result of those shorts, we're going to see these kind of weird rallies where they need to cover this short position, that one doesn't look like what they were hoping, and they're changing their portfolios around a little bit. We'll see these kind of rallies. I think that had a little bit to do with it today, and we'll see where it all goes. I think that, there's still big pressure on the market to the downside. It's going to really be tough for corporations to grow their earnings in the face of higher interest costs. We'll see where things go over the next coming weeks and months. A little bit of interesting news today from our friends, the Federal Reserve. Well, first before I get to the Fed, which is a subject that could be an hour, I want to talk for just a second about this gas tax holiday you might have been hearing about. The president's talking about putting a gas tax holiday in, trying to save people some money at the pump. Federal gas tax is around 18.5 cents, so let's just round up and say 20 cents a gallon. So that would theoretically reduce prices at the pump about 20 cents a gallon. My question is this: how many of you guys believe that 20% cut will actually trickle all the way down to your gas tank? I got a feeling that the producers, the middlemen, the gas stations, and all those guys, they're going to scoop that 20 cents per gallon up before it even gets to you. So I really don't see that as something that is going to be a big benefit to the consumer. I think that it's going to be painful for our friends in the government because it's just more revenue they're not collecting, adding to the deficit, adding to the debt, and it's getting untenable, guys. We had the Federal Reserve and the ECB. If you've seen over the past couple of days a crazy bounce in the bond market, it's really hard to believe that money is coming from the public. So we got to believe that the central banks are in there propping up their debt markets. The ECB actually put an announcement out about using extraordinary measures to stop the market from what they call fragmenting, which I'm guessing is another word for imploding. They're going to be active in the markets. It's just for sure. Inflation continues to keep climbing here in the U.S. and around the world. UK reported their highest inflation rate in over 40 years today. moving on. Basically, this whole thing is moving toward a very simple conclusion. You're going to have a full-blown debt crisis here. I don't see how the Federal Reserve can pull this stunt they're trying to pull off. With the one hand, they're raising rates, and with the other hand, they're creating more money to prop up the debt market. So this is to fight inflation. This is massively inflationary. They're doing both of these things at the same time. It's kind of the equivalent of walking a tightrope where the slightest miscalculation, the slightest misstep, the little bit of wind that blows your way could upset the entire thing. It's just what they're really doing is pretty scary stuff, because if they make a wrong move, it's you and I that are going to pay for that. And, well, people just don't have the money to pay for anything else. Now, raising rates, the biggest loser when interest rates go up is the federal government. The biggest debtor in the world. The federal government and their minions who do the debt, I guess the Treasury, decided that they didn't want to pay the higher rates to buy long-term debt, so they started investing, selling more short-term debt, so they could pay a little bit lower interest rate on that debt and save the government a little bit of money on debt payments. Well, there's just a little problem with that. Now, it's a wonderful idea when rates are going down. Not such a great idea when rates are going up, because every piece of paper, as it matures, that the Treasury has to roll over into fresh debt, you're going to have a pretty significantly higher payment on it. You're going to have a higher rate, of course, a higher payment on that rate. So the government is going to get blistered with higher debt payments. And I got a feeling that how are they going to pay that additional debt when they're already in so far into the red? It's incredible. Do they go further into the red? Do they raise taxes? How are they going to manage that? It just doesn't seem to be a way to have an ending that's going to be great for us, the working people in the country. Chairman Powell, I got to say, I don't know how much his job pays and what kind of fringe benefits and perks he gets, but he's got to have the worst job in the world right now. This guy's got to be facing pressure that's unbelievable. Trying to manage all of this stuff and be in the face of it all it's just got to be a total bummer, because he's going to be under pressure from the political class to not raise rates too high and cause a recession. Well, I think we're well past that point already. And now rates are going to continue to go up. They're going to continue to go up. They're going to continue to go up. And it's all going to be big pressure, because the recession is here and coming. Pretty soon everybody's going to be knowing it. And it's just going to continue to roll down the hill and get worse and worse. The political class is going to scream bloody murder. The Treasury is going to be screaming. Everybody's going to be screaming at him for doing his job. And he's going to be under real pressure to start turning things around and cutting rates. I got to say, if you're Powell, you got the worst job in the world right now. I was reading the Bible this morning, in the Wall Street Journal. Now, this article right here was really interesting. It says, stocks don't often hit the bottom until the Fed shifts their rate policy back to easing rates. And it goes on to say that since 1950, there have been 17 occasions where the stock market has dropped down 15% or more. And on 11 of those occasions, the market didn't hit the bottom until after the Fed started raising rates, or started reducing rates again. So, didn't the Fed already announce that they're going to be raising rates for the rest of this year and into next year? I would say that tells us there's a pretty good chance that this bear market is going to be something that we're going to be dealing with for the rest of this year and all the way through next year, if these numbers are accurate. At least there's a high probability of it. Maybe not 100%, but when you're talking between 60 and 70% probability, I'd rather have that than be on the other side, right? So batten down the hatches, guys. Things are going to get tough. We've been talking about that through all these videos. Get defensive. Look to preserve your capital more than to score giant gains right now. Conservative is going to be the thing to be. at least right now in this market. And when the market turns and when things look like, oh boy, it's time to start getting in heavy with great guns, I promise I'm going to be the first guy telling you guys that. Okay, it's time to take some of that dry powder we've been hoarding, and now let's start putting it back to work in the market. It looks like this big rally, and it looks like the bear market is over. It's time to let the bulls run again. So keep watching, stay with us, and we're going to guide you guys into the best possible position you can be in to capitalize in your portfolio. I've been promising I'm going to answer some questions. You guys have been super awesome about sending questions in every day, and some great questions. I mean, I'm surprised a lot of you guys aren't in the finance business if you're not, because the questions are questions a professional would typically ask, not your basic investor. But I wanted to talk today, a lot of the questions have been about precious metals, gold, silver, platinum. I like all metals personally. I think you got, actually in the Bible today, they were talking about big shortages coming up in zinc and copper. So I think the whole metals market is due for a pretty good rally. As far as the precious metal market with gold and silver, platinum, that market is a little bit different because it's not going to react as much to, say, inflation and interest rates as it's going to react to the dollar, the relative strength or weakness of the dollar. The metals are a great place in an inflationary environment to store your money because they're going to hold their value while the dollar's losing buying power, right? So you'll see if the dollar starts to decline, the dollar starts losing buying power, you're going to start seeing the markets and metals rally. So I think metals are a great part of your portfolio. I'm not saying go out and invest all your money in silver. Go out and invest. No. We don't want to do that. We want to keep our portfolio balanced, right? So we want to have a nice portion of our portfolio in defensive stocks, high-paying dividend stocks. Stuff that's you have to have in a recession or or boom times. People are going to buy soap. They're going to buy food. They're going to buy the stuff. You want to have a certain portion of your percentage in preferred stocks. I prefer those right now over interest-bearing stuff, bonds and stuff like that, because they pay a giant dividend yield and their prices are pretty stable. You want to have a portion of your portfolio in metals to preserve the buying power of the money, and you want to have a certain portion of your portfolio, depending on its size, and more speculative stuff. There is where you have your room for your cryptos and certain different things. Commodities are a great play right now. Metals are part of that commodities market. That market's going to see real returns over the next year and a half. So anyway, that's it for today, guys. I really appreciate you taking the time to watch the video. Please like, share with your friends, continue to comment, ask me questions. The questions that I don't get to so much on the show, I've been trying to get on and answer those questions in the comments section myself. So look for me there. It's a pleasure talking to you guys and providing this service for you. Look forward to talking to you again in comments later today, and we'll see you all again tomorrow. Thanks. Have a great day.